there. Hope everybody's having a fantastic day. Um, it is after April 15th, but we are still in tax season in Florida. It like never ends. My husband actually says this all the time. He's like, "You're always in tax season." And I'm starting to think that he is right. We are always in tax season. But having just come for most people through tax season, and we work with a lot of real estate folks. This is something that seemed really timely. Um, we want to talk about tax mistakes that we see and what you should avoid if you're a real estate investor, because there's no need to leave money on the table and have things go wrong. So that's what we're going to talk about today, tax mistakes to avoid. So we're going to hop on in to the whole thing. Hi, I'm Beth Hochberger, CPA, CGMA, and today we are talking about tax mistakes every real estate investor should avoid. And to me, these are just like mind blowing, because I'm like, it seems so obvious, but I see it over and over again. And maybe you're new and you don't know, but I also see this with like people who've been in real estate for a long time, and I'm just baffled. I'm like, did no CPAs ever tell you guys this stuff? Because that's like, it's wrong. They should tell you. Someone should tell you. So I'm here to tell you. Number one, biggest mistake I see is people who don't keep good records, and it's kind of a hybrid. You don't keep good records and you're missing deductions. You're literally giving the government your money. You're literally leaving money on the table. Every time you have an expense for that rental property, you need to deduct it. You need to keep track of it somewhere. A spreadsheet, QuickBooks, Stessa. Find the method that works for you and keep track of it, because when it comes time to do your taxes, then you have it all there. And you know that you're not just, overpaying in your taxes, because every expense that you forget about and every expense you don't claim on those tax returns is just money out your pocket in the form of taxes. So, huge thing, ignoring deductions. And let me say, Floridians, we pay so much in insurance. If you own a property in Florida, don't come to me to get your taxes done without double, triple, quadruple checking the amount that you have deducted for insurance. I know you're paying insurance. You're paying through every orifice you could possibly be paying for insurance. I know you have insurance expenses. You need to deduct them. Property taxes, right? Repairs, all of these things, make sure you are capturing all of them. The number of times that clients have come in with their little rental summary and there's no insurance, and I'm like, hey, did you pay insurance? And they're like, oh yeah, I did, I forgot. How do you forget? It's so expensive. So make sure you're capturing all of those expenses. And if you're not sure if something is deductible for the property, ask. We'll tell you. We'll tell you if you can deduct it or not. So the next thing, depreciation. This also blows my mind. The number of times I've seen people come to me where in prior years they didn't take depreciation on their rental property. I'm like, guys, like, if you did it yourself and you didn't understand, I kind of get it. That's why that's going to lead to one of our later mistakes that people make. But depreciation is so key in helping to shelter all that rental income and to bring your tax bill down. Because what happens is you buy a piece of property, right? The depreciation is like using up that property over time. So you take the property, you divide it by like 30, 40, like it goes across a lot of years, but every year you get to deduct a portion of the property that's being like used up in effect, right? So it's not the specific mortgage payments, it's the depreciation. So if you don't depreciate the property, you're really missing out. You're missing out in the current year in your taxes because you're short on deductions. And then when you go to sell it and you look at the depreciation recapture, the government doesn't care that you, I forgot to claim it every year for the last 10 years. You get depreciation recapture on the depreciation you took or you were supposed to take. So you're supposed to take it, right? Don't file a return with rental income and no depreciation, please. I'm begging you. And if you don't know how to calculate it, which no one expects you to, honestly, like it's super complicated to calculate depreciation, you need to come find a professional, right? That's what we're here for. We make sure it gets done right. So now, like, moving on, this is like a little bit more complex, so I understand if people don't know about it. But 1031 exchanges are your friend in real estate. If you're selling a property, like a commercial property, like when I say commercial, I really mean like a rental property, right? We're not talking primary residence. That's a different ballpark. But if you have a rental property, an investment property, and you're selling it, unless you're like, I'm getting out, like I just want to get my money out of the property, or I'm getting out of real estate, or whatever the case may be, if you're buying a new one or you're contemplating buying a new one, you should look very seriously at 1031 exchange opportunities. A 1031 exchange is, I take this piece of property, this real estate property, and I exchange it for a different one, and I'm not paying taxes on the capital gains associated with that original property. It rolls into the new property and it carries forward. And believe it or not, you can actually use this as morbid as this is going to sound, you can use this as an estate planning tool. You can 1031 over and over and over again until you die, right? Like, I know it's crazy to talk about things like that, but it's possible. If you can take advantage of it, 100%, it is a possibility. It is something that you can do. So 1031 exchanges, when you're trying to sell real estate, that is something that people neglect all the time. Failing to keep records. Oof, I kind of touched on it before with the ignoring deductions. Why is the record keeping also important? Well, you could get audited. We've seen it happen. It doesn't mean that the IRS actually thinks that you did something wrong. Sometimes you're just unlucky. Like, sometimes people will ask me like, hey, is this thing like a big red flag? Is this an audit problem? Blah, blah, blah. And I'll say to them, like, how lucky are you? Are you the, I win on the scratch off? Or are you like, I get a speeding ticket? Because some of it is just dumb luck, right? And the better prepared you are with your records, the better an audit can potentially go. So really important. Keep those receipts. I personally take pictures of stuff, throw it in a Google Drive, forget about it. Hopefully never to be seen again. But if I need it, I know it's there and I can go pull up what I need. So always want to CYA, right? CYA just in case the IRS comes looking for you, and make sure you have those receipts. And then last but not least, real estate tax is not for the faint of heart. Nobody expects you to actually figure out from TikTok how to do your taxes when you're a real estate investor. Like, it is not expected that most taxpayers can figure this out. Please find help. Reach out to a CPA. Contact my office. Like, we're happy to help you. We'll have a free discussion about what you're doing and what you need to do, et cetera, et cetera. And that's what we're here for. We help people all the time. Our goal is to make sure you are saving money on your taxes, not overpaying. That's what professionals do, right? And by the way, you can't trust everything you see on the internet. I realize I'm out here on the internet giving advice, but you got to be careful, right? So make sure you talk to a CPA when you've got complicated stuff going on, like real estate investments, 1031 exchanges, all this crazy stuff. And that's it. That's my rant for the day, my advice for dealing with real estate and taxes. And we will see you